What was your investment in General Electric?
If you're going to give people summaries of what you think is the best advice is, you better tell people what you've done. And I'm one of the very few people that actually published what I own in my book. Almost nobody does that. People talk about investment blunders and decisions, but they don't talk about what they own. I do. The other thing I had to face was explaining how I screwed up. And this is another behavioral economics thing about bias. I got hired in 1990 and very quickly got a real schooling in investment fundamentals working at CNBC. And one of the people I met very early on was the guy who owned us, Jack Welch, the head of General Electric. And it's hard to describe, you know, John, but to younger people who Jack Welch was, he was like God. He was the corporate titan of the 1990s. And he loved television. He had bought NBC from RCA years ago in the 1980s. And CNBC went on the air. He was a big backer of CNBC. He loved CNBC because it was a financial network, and Jack loved being on TV. And we loved Jack. And I admired him and adored him. And this is where I screwed up. Overconfidence, not in me, in Jack Welch. I thought Jack Welch could do no wrong. First thing I did, opened my 401k with General Electric and started buying GE stock aggressively. By 1999, 50% of my 401k was GE stock. Now, there is no rule on this, but anybody will tell you that is a stupid thing to do. You do not have that kind of money in your own stock. Owning individual stocks are extremely risky. I don't care what anybody tells you, it is. And it is really dangerous to have that kind of concentration. There's no rule on this, but most of the time people tell you don't get anywhere near 10%. Nonetheless, here's what's incredible about this, incredible. I knew that this was a stupid thing. I was the stocks correspondent. It's not like, oh, gee, nobody told me. I cover this stuff. I knew this was dumb. That's how strong biases are. I knew this was dumb, yet my confidence in Jack Welch was so strong that I ignored what I knew to be the right thing to do. This is what I mean when I say these biases really infect your head. What happened? Jack Welch, I have a picture with Jack Welch in December 1999. He came down on the floor. I had an interview with him. We had a big hug. Oh, it's going to be great. Jack Welch retires. What happens? .com blows up. The whole, internet thing blows up. The combination of Welch retiring and the internet thing, GE stock tanks. Well, I still had so much confidence in his successor saying, they'll know what to do. This vague thing, they'll know what to do. I didn't move. I held on to it for a while. And it was such a disaster for me that it set me back years in investing. And I knew this. So eventually I came to my senses, but there's another saw in this behavioral economics thing, prospect theory. People fear the pain of a loss greater than the expectation of a gain. This was Daniel Kahneman's big insight in his very famous book, Thinking Fast and Slow. Of course, I experienced that. And so nowadays, it's very hard to explain to people what that's like. But when you tell a story like that and you say, listen, you can be infected by this. You're not, just because you have knowledge of it doesn't mean it can't happen to you. I know because I had knowledge of this, that this was a bias, and I still did it.
What did you learn from some of the big traders?
Buzzy Gould ran Herzog Hein Gould, one of the best NASDAQ trading firms ever. He was and still is one of the great traders I've ever met. And the thing that you meet with these guys that are real traders, I mean, not buy and hold guys, these guys trade stuff all the time. And they trade for clients and then they trade for themselves, is limiting losses. Buzzy used to say praying is for Saturday and Sunday. It's not Monday through Friday. So praying that you've got a big loss, praying that it's going to come back, not a good strategy. Another great guy was Ace Greenberg, one of the greatest traders I ever met. I sat on a trading desk a couple of times with him in the later part of his career. And he used to say, when the going gets tough, the tough start selling. And you have to really control your losses. These guys never fell in love with stocks. They always used to say, I like the house I own, but everything else is for sale. And the same with stocks. And usually they would never average down. They'd never buy more of a losing stock. That would not be a good strategy for them. For a lot of them, idea generation was a big thing. I knew a guy named John Mulherin. Mulherin was a legendary trader in the late 1990s. He died almost 20 years ago, unfortunately, but he was a truly great man and a really interesting trader. I used to call him once a month. He would not let me call him any earlier than that. And John would pick the phone up and I would say, so here's what's going on. Here's what I'm hearing. This is, their oil stocks are going up. They're selling pharmaceuticals. And he'd always invariably say, they're all idiots. I said, well, I'm just telling you what the trading pattern. He said, they're all idiots. You're just describing momentum traders to me. That's all you're doing, Bob. That's not interesting. That's not how you make real money. You're just following herds, Bob. And he would give me some offhand idea, what he's doing right now. So idea generation and going against the herd were kind of more important than going with the crowd for a certain group of people. But that's really hard to do. The John Mulherins of the world were very few and far between. Final thing I would say about like famous traders, like what makes a trader a great trader, a lot of them had ADD. And I mean that people throw around ADD, attention deficit disorder, as a metaphor for, oh, you don't pay attention. But I mean clinical AD. I knew guys who could hyper focus on what they were doing for very short periods of time, and you have a hard time finishing a conversation with them. These guys, they didn't read books. They might be able to read an article briefly, but they had a hard time focusing for more than short periods of time. And I don't know why. A lot of them just seemed to be that. They were able to focus and unfocus really fast. A great trader is a fairly rare creature. I don't think I could do it on a daily basis. I watch them, but I don't know if I could do it.
What is the New York Stock Exchange like today?
The NYSE is a tiny part of a much bigger company, ICE. I'm a big backer of ICE. Jeff Sprecher is the owner of ICE. ICE kind of started as an upstart bunch of guys trading energy futures on a laptop. That's literally how it started. And eventually, electronic trading of commodities, commodity futures, was the wave. And they blew out the New York Mercantile Exchange and began trading futures of other kinds, including currency futures, and bought the New York Stock Exchange, 2012, I believe. The floor is very different, as I said before. So that kind of open outcry where a floor broker is yelling at a specialist in IBM buying the stock, you don't see that much anymore because it's all gone electronic. So there are floor brokers around, but they have handhelds. You put in the order electronically to talk to the guy. You can walk up to the specialist and say, I'm going to buy 100,000 shares of Pfizer. In the old days, they would write it down in their computer with the badge number. So the verbal statement was a statement of buying because they put your badge number down. You had the badge here. Today, you literally can't even do that. You could still go over and say, I want to buy 100,000 shares of Pfizer to the Pfizer specialist, but you have to enter the order electronically in your handheld, and that electronic order becomes the confirmation. So it's not really an open outcry anymore. It's an electronic transfer, even if you're just standing next to the guy and he's right in front of your face. The importance of the NYSE versus NASDAQ, it's not as different as it used to be, but the fact that there are still specialists on the floor. So essentially, the main differential here is you're paying in the NYSE to have access to one guy who trades just your stock. So what does that mean if you're a company? Well, let's just say you're Exxon. If you're Exxon, you might have access to a guy who trades on the floor and the company above. Suppose Exxon's up 2% and the S&P Energy Index is down 2%. That's a little unusual. Exxon's the biggest stock, and think if Exxon's up 2%, the energy index would be up. But you can call down your office, investment office at Exxon, and call to the office of the specialist on the floor and say, you have any insight into this? And what these guys see now, it's all electronic. So there's 17 stock exchanges, 40 dark pools. They can see the trading activity in all of these places. They may not know the name of everybody doing it, but they know things that are associated. So it could happen like this. Hi, I'm from Exxon. What do you guys think there about trading today? Exxon's up 2%. S&P Energy's down 2%. Well, we don't know, but here's what we can see. The Goldman Sachs dark pool has, pick a number, 2% of your trading volume normally. Today, it had 15%. Somebody is aggressively buying your stock through the Goldman Sachs dark pool. We don't know who this is. But we do know the following hedge funds are associated with trading in this account frequently. that's interesting because all they want over at Exxon, the investor relations department, IR, is a story because it's 4:02, and in about 5 minutes, the CFO of Exxon is going to wonder, and they're going to call the IR department. And the IR department wants a story. And the CFO may get a call from the CEO asking, by the way, did you notice this? You got any thoughts? And the CFO wants a story. So everybody wants a story. And so if you can put together a story, even if it doesn't say, oh, this guy did it, because that's really hard to find out, but you have some plausible ideas, okay, that is good enough. So what's my point? My point is there's still information on the floor. There's still data. And normally these guys who are the traders are still one or two biggest traders. Most of these guys are often 5 or 6 or 7% of the volume in their stocks. That's not as much as it used to be, but it's still pretty big. So I guess I'm saying the NYSE, you don't see that open outcry as much, but there is still information that's on the floor. And there's still that bell ringing every day.
How was the close of 2024 different from past years?
Art Cashin, who was sort of the doyen of the floor, passed away early December. And Art was very much sponsored a mentor for me. When I got here in the mid-1990s, he was a legendary, floor figure already with Payne Weber. Eventually Payne Weber was bought by UBS. And Art was famous for his witty sayings on the stock market, the fact that he wrote a piece every day, Cashin's Comment, for over 40 years. And Art was an amazing man. He was not an academic, didn't go to college, just stayed in high school here at Xavier High School in New York, but was a brilliant analysis of the stock market, primarily just telling stories. He was a raconteur. And he wasn't an academic and enjoyed talking about it. And I spent decades with him. He was literally one of the great, going out having drinks with Art Cashin was like an episode of Mad Men in 1962. It would start out with, doers on the rocks, several of them. And then he'd order what he called Irish caviar, which is pigs in a blanket. Then maybe he'd order a hamburger. But a lot of nights I didn't make it to the hamburger. I just said, Art was a part of the Wall Street school that I call slow drinkers. Wall Street's famous for the drinkers, but there are several different kinds of them. There's the fast drinkers, guys who order 2 double vodkas and then leave in a half an hour because they got a train. They don't want to hang out. Then there's the casual people. They'll just have a glass of white wine, not much of anything. And then there's the slow drinkers, and Art was a slow drinker. These are guys that, they're not ordering drinks fast. They're going to sit there 2 hours later and they'll be into their 5th doors. And you'll be struggling to keep up with them. He was an amazing guy to sit and talk to. So I'd leave early because I got to go home. And I'd come back in the morning and there's Cashin's Comments in my mailbox. He'd go home at 1:00 in the morning and write these pithy conversations, observations about the stock market that were quite amazing. So every year Art used to sing "Wait Till the Sun Shines, Nellie." It's an old lament. They do barbershop singing on the floor since the 1860s. And with Art's passing, it was tough figuring out who's going to keep that tradition up. So we brought his sons on the floor and they rang the closing bell. It was a wonderful tribute. So the point here is, things change, but to a certain extent, they stay the same. You have to sort of believe and continue to believe in technology and moving on here. I'm very optimistic about artificial intelligence, John. I know you didn't ask me that. We got to go. But the important thing here is what I saw today was in the last few years is I think AI is going to be a tremendous help in analyzing the stock market. The one thing people keep asking me about, can I get rich off AI? Can I have an AI program that will trade stocks and then I can make $1 billion? And of course, the problem is you explain to people that all the other AI programs are going to know what you know. So if everybody knows what you know, under efficient market hypothesis, nobody knows anything more. Everybody has the same information. Now, that could change if access to these AI suddenly scrapes new databases that nobody else has access to. This is what happened with Renaissance, with Jim Simons. They cleaned up old databases and began trading things based on new information that only they had access to. And this is one of the reasons that Renaissance was such a huge success. It is possible that there are groups of people getting access to new, different databases that can interpret data in a different way that may have a competitive advantage. There, AI can be a big thing. But if everybody has the same information, everybody's kidding themselves. I just think it'll help educate people a little easier about what works and what doesn't work long term.